for sure beyond the next couple months.
Great. Well, so very briefly, just want to first introduce Jake, and then I'll let you jump into it. So today we're going to be talking about regulation and legal, because of course, one of the big elements of crypto is the fact that it is such a complicated area when it comes to law and when it comes to regulations. And so Jake has been a longtime lawyer in the crypto space. Of course, he's not your lawyer, he's a lawyer. And he now works for the Blockchain Association, which is one of the leading lobbying groups in DC. And so he has a great deal of insight, one, from what the law looks like from the perspective of crypto operators and crypto companies and founders, but also what the regulation for the space writ large looks like, especially when it comes to the US, but also to some extent, what it looks like from a global perspective. So with that, Jake, why don't you take it away?
Awesome. Thanks so much. Thank you for the intro, and thanks so much for having me. This is, for me, a very fun thing to do. I think one of the most fun things, maybe the best thing about being in crypto is talking to people like all of you who are actually building this amazing future that we all are so excited about and care about. So it's awesome to be here with you tonight, especially on election night. I'm coming to you from Washington, D.C., and the polls are just starting to close. So it's definitely an interesting evening tonight. Haseeb, would it be good if I started by sharing my screen and putting the slides up?
Yes, let's do that.
Okay. So hopefully this will come through. You see that?
Yeah, perfect.
Perfect. Okay. So I guess just to jump straight into it, I will give you a few details about me, and then we'll talk a bit about the roadmap for this conversation. But I'll start by saying I would love to get questions from you all. So I'll pause a few times as we go through the conversation to see if you all do have questions. Then hopefully we'll save some time at the end as well. So hopefully that works out. But as a brief,
Jake, let me pause you real quick. It seems like your mic is clipping a bit.
Give me 1 second. Does that sound any better?
It doesn't seem it's clipping, but so yeah, let's go with that.
Okay, all right. Sorry about that. I also got caught at home. I meant to do this from a better location, but you know, as things happen, I got stuck here in my dining room. So hopefully this is okay.
No worries.
So I guess a quick introduction for me. As Haseeb said, I am head of policy at the Blockchain Association. We are the U.S. crypto industry's main trade association here in Washington, D.C. We have just over 100 members, all US-based crypto companies. And our job, of course, is to advocate for good crypto policy in the US. And I will focus mostly for this conversation on US federal law and regulation, although there is a huge world of US state and also international law and regulation that applies to crypto. Basically, every country you can think of with a meaningful capital market has taken an interest in crypto. So maybe we'll touch on that just a little bit. Also, as Haseeb said, I am a lawyer, but I am not your lawyer. So my usual disclaimer, nothing I say here is intended as legal advice. If you are or plan to be a Web3 entrepreneur, which I hope that all of you are, you should definitely go hire your own lawyers and get your own legal advice. But hopefully I can at least give you some guidance during this conversation as to how to go about that task and how you should think about law and regulation in your own work. Separately, I am also an advisor at Variant Fund, and I'm a board member at the DeFi Education Fund, so doing policy and regulatory work across the board there. And I'll skip over the rest of this so as not to bore you, but except for the very last piece, which is I really am happy to hear from you all. So even after this conversation, please feel free to reach out by email or Twitter if there's anything you're working on that you want some quick thoughts on or want to talk about anything else of interest from this conversation. A quick roadmap for the discussion. We're starting out with an introduction. That's where we are now. Once we get through just a little bit more, we'll talk for the most part and for the largest section of this conversation about who the regulators are that you should know, again, from a US federal perspective, and also what their legal frameworks are, what the issues are that they're dealing with, and how, as a Web3 entrepreneur, you can think about navigating those regulatory frameworks so that you stay on the right side of those regulators. We'll then very quickly flag just a few of the current issues, some of the developments that we've been looking at recently, mostly to give you a flavor of just how fast this space is evolving and how important it is that you keep up on the latest developments so that you don't fall behind. And then we'll close with some general points on Web3 legal strategy, right? Let's say you're a founder and you have a new startup. What should you do on day one, and how should you think about compliance with crypto and Web3 regulation? And then hopefully we'll have some time left to take some questions. Let's start, though, with just a general overview of the basics of regulation. What is regulation? Why do we have it? Where does it come from? And how should you think about it? So for starters, what are regulations? And basically, regulations are rules that prohibit conduct or that condition conduct on compliance with certain obligations. And those are two separate things worth thinking about separately. First, rules that prohibit conduct. Think of this like absolute prohibitions on certain types of activities. And usually that's in the context of the criminal code, right? You are not allowed to commit assault, period. You are not allowed to commit robbery, period, right? There are certain things that you are just not allowed to do. And those are regulations of a sort. They regulate the type of conduct that you can lawfully carry out. But when we talk about crypto regulation, more often we're talking about that second category, which is activities that you're allowed to carry out, but that if you want to carry them out, there are certain conditions that you have to satisfy, right? Certain obligations set out in law that you have to comply with. And if you don't, you will be found liable for committing a violation. And those violations are punishable by fines, sometimes by restrictions, right? Maybe you won't be allowed to make certain types of investments anymore, or a court will order you to change your business in a certain way or to stop engaging in a certain type of activity. And of course, in the worst case scenario, if there is a criminal violation, then imprisonment, right, jail time is possible. So very important to pay attention to the legal and regulatory considerations in whatever you're doing in this space. Why do we have regulations? There are a lot of different theories of regulation, and the truth is we could teach an entire course just on that question. But I think the simple answer, and the one that you'll hear most in the US federal context, is the belief that, as we have this quote here, the market cannot be left to its own devices. In other words, free markets are not good markets. Free markets are subject to flaws and failures that, left to their own devices, will result in harm for investors and consumers, systemic risk, all kinds of problems that happen in a totally unregulated space, and therefore regulations are justified to achieve governmental interests that address those failures and those flaws. So for example, regulations might apply to control market power. In other words, there's one company that is so big, it acts like a monopoly. And in order to address the problems that come from monopolies, to control market power, regulations might be appropriate. Similarly, to facilitate competition, right? Competition is one of the most important elements of a capitalist system, right? It's sort of the basis of how the US economy is built, is on the assumption that markets are open and accessible and that new competitors can come up to build products and services and challenge incumbents. So often regulations facilitate competition. And any other reason you can think of that there may be a governmental interest in achieving, right? Stability, attracting investment, promoting fair and efficient markets, protecting consumers. All of these things are reasons for regulation. Who makes and enforces regulations? So in the US context, there's both state regulations. So all 50 states have their own unique bespoke regulatory regimes. And then there is US federal regulation, which flows from here in Washington, DC. And at both levels, regulations initially flow from laws that are made by legislatures, right? The US Congress passes laws, or a state legislature passes laws, and that is the authority that creates whatever the regulatory regime will be. But it goes beyond just the legislature. You also have the executive branch, right? Our three branches of government, the legislature, the executive, and the judiciary. The executive is responsible for enforcing the laws. And in the modern era, enforcement means a lot more than just saying whether someone has followed the law or has violated the law. Enforcement also encompasses rulemaking and implementation of those regulations that the legislature has passed. So often the legislature will pass a very broad framework for regulation, but then it will be the administrative agencies in the executive branch, which we'll talk about throughout the rest of this conversation, who actually decide what are the nuts and bolts of those regulations? What are the obligations that you have to comply with? What is the meaning of some of those laws that the legislature has set forth? And then, of course, the buck stops with the judiciary, meaning the courts, right? The legislature passes the laws, but they can't pass unconstitutional laws. The judiciary can always say laws are unconstitutional and therefore invalid. Similarly, with the executive, they can do rulemaking, they can bring enforcement actions, but ultimately it is the courts that will decide if the executive has gotten it right or not. So all three branches of government very involved in making and enforcing regulation. How should you think about regulation? So again, let's sort of assume that you guys are founders or founders to be, and that's how I'll sort of treat you for the purpose of this discussion. What should you as a non-lawyer think about when it comes to regulatory compliance? And I think there's basically two things that you should think about. One is you should try to learn enough about regulation so that you can do issue spotting on your own. What I mean by that is, as you're going about your business, when certain things happen, right? Certain counterparties want to do transactions with you, or you come up with certain products or services that you want to build or launch, you should have in the back of your mind some of the most important regulatory issues that you might press up against, just so that you can spot those issues and know when it is time to bring in an expert. And that's the second thing, which is know when it is time to hire a lawyer and bring in an expert who can help you to navigate whatever regulatory issue you think you might have. I know that talking to lawyers is not always the most fun thing in the world to do. It's also not the most inexpensive thing to do. Lawyers are very expensive, but unfortunately, it is just part of the cost of doing business in crypto. So if you want to be involved in Web3, you're going to have to get comfortable talking with lawyers. And we will definitely come back to that in a bit more detail at the end of this conversation. That's it for the introduction and for the basics of regulation. I do want to pause just for a second here to see if anyone has any just preliminary questions about the US regulatory world or who's involved in making regulations before we dig into what the most important regulators and frameworks are. So any questions so far?
There was one set of questions in the Q&A. So Xingyi Yang asks, two questions. One, are there countries that recognize the currency properties of cryptocurrencies?
So there's a very small number of countries that actually say that a cryptocurrency is legal tender. In other words, it's the same as a sovereign currency. I think the best example of that is El Salvador, which decided to make Bitcoin its legal tender. But there are very, very few examples of that. I can't even think of one other than El Salvador. And for the most part, governments treat digital assets as property, not as national currencies. Maybe they get treated as securities or some other classification, but not really as sovereign currencies.
The second question is, the blockchain is unregulated, but it is traceable. Once a person is bound to an address, is there a way for assets on this address to escape supervision?
That's a great question. We're going to get a little bit more into that in a few slides. My very quick answer is, when you say escaping supervision, what I hear is exercising the right to privacy. And I think right now, blockchains are not very private, meaning if you have a wallet address that is linked to your personal identifying information, right, your government provided identity, it is quite hard to break the link between your identity and those assets that are in the wallet that you control. I think that that should change, and I think that we should have more privacy rights, and I think there should be nothing wrong with that. And that's one of the many policy issues that we've been battling out, and I think we'll continue to for a number of years to come.
Got it. Last question. Tracy asks, what are the sources that you'd recommend to keep updated with the latest regulations?
Super difficult question. Honestly, I hate to say this, I think crypto Twitter is the best way to stay up to date on what's going on in crypto, including in regulation. You can follow me on Twitter. I usually tweet about important things that are happening. There's probably a couple hundred other people who are really on top of this. Outside of that, I would say the same way that you stay up to date on all developments in crypto work for regulation too. Podcasts are awesome. Listen to Haseeb's podcast, Chopping Block on Unchained. It's really fun. It's also really great. And they do talk about regulation quite a lot. So you can pick up a lot from there. Other podcasts, Crypto Media, CoinDesk, The Block, Blockworks, folks like that are pretty good at staying up to date. And then if you are a founder and you have a law firm on retainer, you should expect them to keep you up to date on the most important things that are happening if they will affect your business. I think that's the best answer I can give you.
Cool. Keep going.
Awesome. All right, sweet. So let's jump into it. Here's what I'm going to do. I'm going to walk you through what I think are the 5 most important regulatory frameworks that you should know. And then I'll give you sort of a lay of the land of the dozens of other issues that you should at least have in the back of your mind as you move forward. And then we'll sort of move on from there. But I'm going to start with the US federal securities laws. I think by far the most important that any of us in crypto have to deal with, and unfortunately an area that a lot of non-lawyers have had to learn a whole lot about because of the potential ramifications of tripping the securities laws in crypto. For starters, I'll tell you about the Securities and Exchange Commission, the SEC, which is the federal agency that administers the securities laws. The SEC has a 3-part mission. Their job is to protect investors, to facilitate capital formation, and to maintain fair, orderly, and efficient markets. And to step back from that for a second, I think it's good to know how the securities laws came into existence in order to understand how and why they would apply in the context of crypto. The securities laws did not exist until the 1930s. They were created in the wake of the Great Depression. Basically, what happened was in the 1920s, in the post-World War I period, all of these American entrepreneurs said, we're going to go rebuild Europe. We're going to start extremely profitable and successful businesses in previously war-torn France and Germany and elsewhere, where there is extraordinary opportunity for us to make a huge amount of money. And all we need is for you, the American retail investing public, to give us your capital. And we promise we will return it to you many times over. And that really is what happened in what was called the Roaring 20s, a period of extraordinary financial wealth generation, and also the creation of a huge bubble. Because unfortunately, unknown to many of those US investors, those businesses were not legitimate, right? There wasn't really so much opportunity there as much as there were just entrepreneurs who were selling a story, right? Belief in this opportunity that didn't actually exist. And so the reaction to that in Congress in the 1930s was to say, this bubble was created by financial abuse and information asymmetry between the issuers of assets and the purchasers of those assets. Information asymmetry meaning the issuers of the assets, the seller of stock, the person promising they were going to build this successful business using the capital of investors, they were the ones who had the information necessary to evaluate whether the investment was really a good idea or not, right? What's actually going on in war-torn France, what the market really looks like, what the opportunity really is. And there was an asymmetry between those issuers and the purchasers of financial instruments, right? The investors who had no way to find out back in the 1920s and 30s what was going on in Europe. They were reliant on the promises made by the entrepreneurs, the people raising capital. And so Congress said, we need to address this information asymmetry. We need to make sure that issuers of securities make disclosures to investors so that investors have the information they need to make informed decisions about the investments that they make. And that's how the SEC came into existence, initially as a regulator of securities themselves, right? Stocks or bonds or other types of securities that are defined in the federal laws. As time went on, the SEC also expanded to regulate not just securities themselves, but also the markets where securities trade. And in later years in the 1930s, they got jurisdiction over exchanges, over investment companies, over brokers and dealers and advisors. And at this point, basically anyone who operates in the securities markets has to be regulated by the SEC in one form or another. So that brings us to crypto. Why is the securities law important for crypto? And the answer is because securities are subject to a very onerous, very burdensome regulatory regime. If you want to issue a security, right, if you want to sell stock in a company to the public, you have to do an IPO. That's what the IPO process is. It's required by the securities laws. You go to the SEC, you register your stock, you do all kinds of disclosures. It's extraordinarily expensive. It also means that those securities can only trade within SEC regulated venues, right? On the New York Stock Exchange or on NASDAQ or some other registered and regulated venue, and can only be custodied by SEC approved custodians. None of this works for crypto, right? We are trying to build a decentralized, permissionless financial system where these assets can trade among any people without restrictions and can trade in any venue, whether it is approved by the SEC or not. So if you want to issue a digital asset and have it work in a decentralized, permissionless environment, it cannot be a security under current regulations. So a huge amount of effort and time and resources are spent in crypto trying to avoid securities designation for a given digital asset, right? To put it more simply, your token cannot be a security or it is dead on arrival. So that's why the securities laws, at least in the first instance, are so important. Avoiding designation as a security if you are a token issuer. I don't want to get too deep into the legal weeds, but I do want to cover just this one test, and also to give you a flavor of how hard it is sometimes to do the legal work behind some of these issues. I want to tell you about the Howey test. The Howey test is a four-pronged test that the SEC and also all federal courts use to determine whether a given asset is an investment contract, which is one type of security listed in the securities laws. And it's the one that gets invoked most in the context of crypto. If you're asking, is my token a security? Really what you're asking is my token or a given token an investment contract under the Howey test? The Howey test, like I said, has four prongs. A token is a security under Howey if there is an investment of money in a common enterprise with a reasonable expectation of profit based on the efforts of others. And I'll run you through an example of how you do this Howey analysis in just a couple minutes. But first, I just want you to understand this test is not well understood and it is not clear. So no amount of my explaining it to you will help you to know with any degree of certainty whether any given asset is or is not a security. The analysis really started back in July of 2017 in the DAO report, and I'll tell you maybe a bit more about that. But over the course of the last 5 years, the SEC has sent many different signals about how it interprets the Howey test. And most recently, just a month ago, the chair of the SEC had a quote to CNBC that I thought sort of put this all in context, which was, quote, "The law is clear. I believe based on the facts and circumstances, most of these tokens are securities." And what he's saying there basically is he thinks most people who are working in crypto have broken the law. And that's a really weird place for us to be in, but you should just understand going into this, that is where we stand under the securities laws now. There's a lot of uncertainty, and we know that the SEC does not agree with our interpretation of the law. And this is something now that is unfortunately being fought out in the courts. But to circle back, let me give you a bit more context about Howey and how it works. In June of 2018, there was a really famous speech that this SEC official Bill Hinman gave, which really set the stage for how to understand Howey in the modern markets. What he said was, when he looks at Bitcoin and also Ether separately, he does not think that they are investment contracts under the Howey test. And here was his explanation. He said, okay, sure, there was an investment of money. If you buy Bitcoin, you're investing money. And he said, sure, there's also a common enterprise. Everyone who has Bitcoin has their fates intertwined. They have a common fate, right? Bitcoin will either rise in value or fall in value together. Therefore, all Bitcoin holders are in a common enterprise. So the second prong is satisfied, just like the first. And third, he said there's a reasonable expectation of profit. People think Bitcoin is going to go up in value. That's why people are buying Bitcoin. So that prong is satisfied as well. However, he explained, the expectation of profit if you buy Bitcoin is not based on the efforts of others. And I'll give you this quote from his speech, which I think clarifies this to a great degree. He says, if the network on which the token or coin is to function is sufficiently decentralized, and it's a key term, sufficiently decentralized, where purchasers would no longer reasonably expect a person or group to carry out essential managerial or entrepreneurial efforts, the token may not represent an investment contract. And when he looked at Bitcoin, what he said was, Bitcoin looks way more like gold than it looks like a company's stock. If Bitcoin goes up in value, it's not because Satoshi Nakamoto or some small group of people are carrying out essential efforts of the sort that you would expect a company to carry out. Instead, if Bitcoin goes up in value, it's because there is this large and vast ecosystem of different companies and people and market forces that will lead Bitcoin to go up in value. And no individual person or company has special information, right? Privileged access to information, such that there is an information asymmetry justifying registration and disclosures, right? You don't need Satoshi Nakamoto to register with the SEC and make disclosures about what he, she, or they are working on next in Bitcoin to understand the value proposition of investing in Bitcoin. And therefore, he says, when he looks at Bitcoin today, he does not see a central third party whose efforts are a key determining factor in the enterprise. He said sort of the same thing about Ether, and I think this is pretty important too. He said, and putting aside the fundraising that accompanied the creation of Ether, we'll get back to that, based on my understanding of the present state of Ether, the Ethereum network, and its decentralized structure, current offers and sales of Ether are not securities transactions. So again, he's saying the Ethereum Foundation, right, Vitalik Buterin does not need to register with the SEC and make disclosures about Ethereum for investors to understand whether Ether is going to go up or down in value. They are not a central third party carrying out essential efforts. And that really is how you should think about the securities laws and the Howey test broadly as applied to digital assets. The question is, does it look like a stock where there's one person or one company promising to make it go up in value? Or is it a decentralized ecosystem like Bitcoin or Ether or gold or diamonds? Well, diamonds are a little bit of a different case, but we'll leave that aside for a second. But again, where there's a big ecosystem of many different participants, no one of which you need disclosures from to understand the value of the investment. That first sentence is a really important one, putting aside the fundraising that accompanied the creation of Ether. And this gets us into the question of initial coin offerings and when people have done this wrong, when digital assets have been issued that the SEC says are securities. And we can learn a lot from those cases because we can learn what to do from what not to do, right? How others have gotten this wrong. And what Bill Hinman was saying in that first sentence is, when Ether was first sold, it might have been a security back then. Because at that time, right, in the early days of Ethereum, well, maybe the Ethereum Foundation did have information that no one else had access to that they should have disclosed. And that still is sort of an open question, whether Ether might have been a security at some point in the past. But let's talk about some of the clearer cases for context. And then I'll pause and we'll love to get questions on the securities laws. A really important case going back a couple slides is the DAO report, July of 2017. And in short, the DAO was an investment fund built on the Ethereum blockchain. The point of the DAO was for anyone who had Ether to contribute Ether to this fund, and in return to get tokens that they could use to vote on how the fund would be deployed, how it would be invested. The idea was to democratize venture capital. And I think that's a really great idea. And unfortunately, the SEC didn't necessarily agree because the SEC said DAO tokens, these tokens that investors could use to vote on what investments the DAO would make, were securities. And the SEC's reasoning was, although the DAO token holders had control over this enterprise, right? Although they got to vote on what investments would be made, they were reliant on the initial team called Slockit, the company, the developers who had created the DAO. They were reliant on that team to actually find the investments and do the due diligence and propose those investments to the DAO. And in fact, the initial team that created the DAO had maintained in the DAO a privileged role, the role of quote unquote curator. And in fact, only they were allowed to propose investments to the DAO, and there was no way to replace them. And so what the SEC basically said was that development company, right, those initial creators of this fund and this token were an essential party to the token's success. Without them playing that role of curator, there was no way for the DAO token to increase in value, and therefore the investors were reliant on the efforts of others in order for the value of the token to go up, making the token a security. A couple other sort of similar examples from more recent cases are Telegram and Kik. These are two really big cases you'll see over and over again, or if you talk to lawyers, they'll tell you about over and over again from 2020. And both are very similar, Telegram and Kik, both instant messaging platforms, both proposed to create tokens that would be used on the platforms. Both of them sold the tokens before they had actually built any functionality for the tokens or in any kind of decentralized project. And they sold the tokens on the promise that they would later carry out efforts that would create value for those tokens. And the SEC showed up and said, look, these tokens are non-functional. The only reason they would ever have value is because of the efforts that these development companies will carry out to bring value to those tokens. And the only reason those tokens will have value is because of the proprietary messaging platforms that these companies have built. And as a result, those companies are essential actors in those, those projects, and therefore the tokens that they've issued are securities. The SEC said something very similar in the case of Library with the LBC token. I think maybe yesterday or 2 days ago. I sort of can't keep track of how fast things are moving here. But that's sort of the ICO situation. The moral of the story for those of you thinking about tokens is as follows. Do not sell tokens promising profit based on efforts that you, the issuer of the asset, will carry out in the future. If you do that, the token is very likely a security. And the industry standard that has really developed in the last couple of years is, if you want to issue a token, you need to do all the work up front. If you want to build some decentralized protocol, build the protocol first. Make sure that it is functional. Make sure that your work is complete. And then if the project would benefit from a token, create the token and distribute it later, making no promises about what your future efforts will be, and also having set up a system that will survive even if you do not, right? Set up a system that will continue to run exactly as it is designed, even if your company goes bankrupt and you all decide to go do some other type of work, right? Make sure that it is sufficiently decentralized in that way, as Bill Hinman explained. And then the last piece of color I want to add here before pausing for questions is just to note that we've spent the last, 15 minutes or so talking about the analysis of whether tokens are securities. But you need to think about the securities laws, even if you do not plan to issue a token that may or may not be a security. Because again, all securities market participants are regulated under the securities laws. That means if you want to manage assets for other people, you may be regulated by the securities laws. And you'll see here, the SEC about 4 years ago had a settlement with a company that was acting as a crypto fund manager without registering with the SEC. The same thing for exchanges. If you want to run an exchange on which these assets are traded, the SEC will try to regulate you. And whether that means you're a Coinbase or Kraken or FTX or Binance or one of these centralized platforms, or you are in some way involved in a decentralized exchange protocol, this is something you really have to think about. I've put the Ether Delta enforcement order here for you to look at in the future. I have decentralized in quotes there because Ether Delta was not in any way actually a decentralized exchange, although the SEC will tell you that this is precedent for their right to regulate even DEXs. So just keep that in mind. And then the same thing with lending platforms. BlockFi was a crypto lender. The SEC settled with them for, I think, $100 million fine over the interest accounts that they were offering, saying that those interest accounts, which did not involve tokens necessarily at all, but that the promise of yield was itself an instrument that qualified as a security. So whenever you have these types of transactions, right, the promise of profit and investment in a common enterprise based on the efforts of a third party, you have to think about the securities laws. Let me pause there. What questions do we have about this issue?
We got one question from Yusuf, who asks, what do you think the SEC is going to do with respect to classifying all these tokens as securities?
It's a great question. The short answer is, I think that they will continue to do what they've been doing, which is a pattern of regulation by enforcement. So on an earlier slide, I showed the guidance that we've gotten from the SEC up through April of 2019. That was the last guidance that we ever got from the SEC. And if you do think about issuing a token, you will have to look at this April 2019 framework that the SEC put out, which is a list of about 60 something different factors that they consider when they're looking at the Howey test. Very important. But they have not given us any guidance since then. Instead, what they've done is they've launched enforcement action after enforcement action after enforcement action, not telling us what their view of the law is until a court forces them to do that, often many months into litigation. So at this point, we don't really know what the four corners of the SEC's views on the Howey test are. And I think that they won't tell us. I think they'll just keep filing cases against people who they think have broken the law, expecting us to sort of figure out from case to case what their views are. It's a sad state of affairs, and my job is to get a better result than that. And we have plenty of ways that we're trying to do that, both through litigation, trying to get clarity from the courts that the SEC is wrong on a lot of this stuff, also through legislation. So I think Congress will not put up for much longer with an agency that is this hostile to an industry that is this important to our national interests. So my hope is that Congress will step in and fix some of this. But until that happens, we'll just have to sort of keep playing it out. You're on mute.
Whoops, thanks. So Paul asks, what about stablecoins? How are stablecoins classified or governed?
So also a great question, and also no clear answer to that. So a year ago, I think maybe last November, the President's Working Group on Financial Markets, which is this group of basically all of the top regulators, put out a report basically saying stablecoins need to be regulated, but none of the current federal agencies have authority to regulate stablecoins under current law. Basically what they said was Congress must take action. And so for the last year or so, there's been a huge amount of discussion in DC about legislation to regulate stablecoins. The President's Working Group did say, if Congress doesn't step up to do its job, well, maybe there are some theories about how the current agencies could regulate stablecoins. Maybe stablecoins are securities, which I think is sort of a preposterous idea. How could you expect profit in an asset that by design will not go up in value? On the other hand, there are other tests for different types of securities. So maybe stablecoins aren't investment contracts. Maybe they're notes under the Reeves test, which I did not get into here, but again, just showing the complexity of these issues. Possible stablecoins are securities. The PWG says maybe stablecoins are derivatives, swaps, right? An asset that represents the value of an underlying other asset regulated by the CFTC, and we'll talk about that in just a few minutes. But honestly, I think that the answer here is Congress will take action and we'll get some stablecoin legislation in the next year or so, and we'll have a whole new regulatory framework for stablecoins. That's my guess.
Okay, and then last question by Edgar. He asks, how is regulation in other countries, especially the EU, similar to how the US treats crypto and securities? And how does it affect things if there are people from around the world who are participating in a protocol?
Both awesome questions. And I'll try to give you the short answer so we can get through as much of this as we can. Very different in other countries in at least two ways. One, securities designation in other countries is not a binary like it is in the US, where either a token is a security and it's dead, or it's not a security and it's totally fine. It's possible under many other countries' securities laws to actually comply with the requirements of the securities laws in crypto without having to say, no one can trade this asset except for accredited investors and SEC regulated exchanges and broker dealers. So the restrictions and the compliance obligations are just very different. The other really big difference is the US is unique in having two separate financial markets regulators. So we have the SEC, and then we have the CFTC, the Commodity Futures Trading Commission. And there's a lot of debate about which one of them is the right regulator for crypto. A very weird issue that you don't see in other countries where there is just one financial regulator. So like in Singapore, there's the MAS, and they just are the regulator for all secondary markets, for financial markets. So they just are the people who are going to regulate crypto. So there's a lot less hemming and hawing about who's going to take charge in other countries than there is here in the US, which really features in a lot of the discussions we have now about regulation.
Got it. Cool. Let's move forward.
All right, good stuff. Let's talk about, and the security section is by far the longest, so we'll try to speed through the rest of these regulators and frameworks so we can talk a little more about Web3 legal strategy and how you guys should address this. But next up is the CFTC, the Commodity Futures Trading Commission. And like I said, the CFTC is the other financial markets regulator in the US other than the SEC. Their job is basically to do for the derivatives markets what the SEC does for the securities markets. So the CFTC's job is to regulate all swaps, options, margin trading, leverage trading, everything that falls under the basket of derivatives and leverage goes to the CFTC. Initially, the CFTC was created to regulate derivatives in the agriculture markets, not financial derivatives, right? Think of the farmer who doesn't know at the beginning of the season if they're going to have a good crop or a bad crop, and so they want to hedge that using futures. That's really what the CFTC was for. However, over time, and especially after the global financial crisis in 2008, the CFTC's role and responsibilities were greatly expanded to apply also to financial derivatives, right? This is largely because the global financial crisis was viewed as being caused by high risk derivatives in the mortgage-backed securities space. And so there was a view that those markets ought to be regulated, especially the swaps markets. And so what that means is, to the extent that there are derivatives in the crypto space, the CFTC has jurisdiction over them, just like they do for all non-crypto derivatives. The commodities laws are a bit draconian in that what the law says is it is unlawful for a US person who is not an eligible contract participant, we'll come back to that, it is unlawful for a US person who is not an ECP to enter into or offer derivatives transactions outside of CFTC regulated venues. What this means is if Haseeb and I wanted to enter a swap transaction, it would be illegal under US law because at least one of us is not an ECP. Maybe one of us is, but ECPs, broadly speaking, are people with very significant net worth or institutions, right? Investment funds and other types of institutions that get sort of shepherded in here. But the point is, US persons, average citizens, are not supposed to trade derivatives. The policy perspective of the commodities laws is derivatives are weapons of mass financial destruction. They are too dangerous for retail investors to transact with. And that is why it is not legal for most people in the US to trade on leverage or to trade swaps or futures. The CFTC has approved a small number of crypto derivatives. There are a few futures contracts that trade on the CME, which is the biggest US derivatives exchange. But by and large, most crypto derivatives are not legal to trade. So an exchange like FTX can't offer derivatives in the US, the same with Binance, the same with Bybit, and all the others. We've seen a lot of activity from the CFTC to enforce that restriction. The biggest case that you may know about deals with an offshore exchange called BitMEX, sort of known as the original derivative exchange for crypto. They invented a very popular product called a perpetual swap. And in August of 2021, the CFTC went after them because there were a total of, I think, 5 US persons that were trading on BitMEX. So that's all it takes. If you are trying not to offer a derivative to the US market, you must block literally every single US person, or else you will be subject to CFTC jurisdiction. And if you're not registered, you will be found in violation. And indeed, BitMEX was not flawless in keeping US persons off of their platform, so they ended up the target of an enforcement action. The same thing happened to a project called Polymarket at the beginning of this year. This was a big deal because Polymarket was at least branded as a DeFi derivatives platform, right? As a decentralized platform built on a blockchain. And what the CFTC basically said was not sufficiently decentralized, right? Not decentralized enough. Too much of the Polymarket system was being run by the Polymarket company, which was based here in the US. They ran the only user interface to access the markets. They were the only people who could resolve how markets would come out. It's a prediction market platform, and only Polymarket could decide basically which predictions were right and which ones were wrong. And so the CFTC said prediction markets, which are viewed as derivatives, are regulated and can't be offered to the US, including in the way that Polymarket tried to do it. And then most recently, and I think most disturbingly, although I'll spare you the details on this one, just 2 months ago, the CFTC brought an enforcement action against the founders of a DeFi protocol called BZX, but also brought an enforcement action against the DAO that had the power to modify the code comprising the protocol, UkiDAO. And basically what the CFTC said was, all members of this DAO are individually, jointly, and severally liable for the activity of the protocol because the DAO is an unincorporated association that should be treated just like any other business. And that business was operating a derivatives platform available to US persons. So the CFTC has become very aggressive in enforcing those rules. Let me stop there. The CFTC will be most relevant for those of you who are interested in derivatives. It may be that the CFTC at some point will get jurisdiction beyond just derivatives. They do already have anti-fraud and anti-manipulation authority. So if you're committing fraud with respect to any commodity, not just a derivative, the CFTC can come after you. But otherwise, their scope of authority is somewhat limited for the moment. So any questions about the CFTC, about the commodities laws or derivatives or anything there?
So there's one question asking, there are some tech companies that engage directly with the CFTC, like Kalshi, which is a prediction market, to create new types of markets. Why haven't companies in crypto done the same?
Great question. So many crypto companies have tried, including FTX as an example. FTX wanted to offer derivatives to US persons. They wanted to do it using their automatic liquidation engine. And they went to the CFTC and submitted a proposal basically saying, look, we know this wouldn't ordinarily be allowed, but we think we have really good arguments why in this case an exception should be made. And the CFTC has been very receptive to that. They actually published FTX's proposal for public comment. They took it very seriously. I don't know what the fate of that proposal will be given recent events, but indeed, many industry participants have tried to make headway with the CFTC. The problem is, and I think what's stopping most people from making progress with the CFTC is the commodities laws are designed to mandate intermediation. So let me explain that a little bit. After the global financial crisis, regulators said, we did not see this financial crisis coming because we did not have insight into the black box of swap transactions. We didn't know what swap transactions were being entered, so we could not monitor and have transparency into systemic risk. And the conclusion was, to fix this problem, we should just force everybody in the US to execute all of their swap transactions through an intermediary. And then we will regulate that intermediary, and the intermediary will give us transparency into all of the transactions that are taking place. The problem for crypto, and this is true across regulatory frameworks, is that we are building a disintermediated financial system. We are literally taking away this one tool that regulators rely on, right? The ability to coerce intermediaries who they can punish if those intermediaries don't comply. We're taking those away and we're saying, sorry, all you have is code. And code is not going to respond to your subpoenas or your investigatory requests or your inquiries to improve compliance. And regulators are not comfortable with that, right? We're trying to get them comfortable with that. Our view is autonomous self-executing code can actually achieve these regulatory objectives much more effectively than intermediaries, which actually introduce risk much more so than they eliminate or mitigate risk. But it's going to be a long time before we can convince folks who've thought about intermediaries as the core of the regulatory regime to sort of bring them around. So I think it's just going to take a long time to get there.
Cool. There's one more. I think we're going to move on.
Okay. All right. Cool. And obviously, if you guys come up with other questions later, feel free to raise them later or get in touch with me afterward, and happy to keep talking about this stuff. The anti-money laundering laws, also extremely important, and we'll spend maybe a bit more time on this one than the commodities laws. The anti-money laundering laws are a, generally speaking, global framework that is meant to reduce illicit financial activity and to prevent criminals from abusing the financial system, also to detect when they are committing crime and help law enforcement track them down, arrest them, and prosecute them later. In the US, the anti-money laundering laws fall under the Bank Secrecy Act and its implementing regulations, which are administered by FinCEN, the Financial Crimes Enforcement Network, a bureau of the US Treasury Department. And the way the Bank Secrecy Act works and the way anti-money laundering compliance generally works is, again, by focusing on financial intermediaries. What it says is, if you are a financial intermediary, meaning you are carrying out a specific type of activity listed in the statute, you're a regulated financial institution like a bank or a casino or a precious gems dealer, or this long list of different types of regulated institutions, you need to do KYC, know your customer. In other words, due diligence on who your customers are to find out their names, their birth dates, their home addresses, their social security numbers, where the source of their money comes from, the purpose of their transactions, and any number of other data points about your customers. And then you have to report all of that to the government. This is the basis of the anti-money laundering regime. And basically the way this works is the government, knowing that they do not have the resources to track down every criminal in the world, have basically decided to deputize all of our financial institutions to perform this task of financial surveillance and reporting on their behalf. So it kind of turns these financial intermediaries into government agents who are going to watch everyone else's transactions and then report on them. And again, the problem for crypto is what we are doing with a permissionless public blockchain is removing the intermediary from the equation. So no longer is there some intermediary who can monitor transactions, collect personal identifying information, and then report that to the government. Instead, we have peer-to-peer transactions. And that, of course, is a big challenge for how the anti-money laundering laws function. For our purposes in the industry, it's really important, again, not to be designated as a regulated financial institution. Just like you don't want to offer derivatives to US persons without being registered with the CFTC, you don't want to offer a security without registering with the SEC, you do not want to be an unlicensed regulated financial institution. The penalty for being an unlicensed financial institution is a criminal offense. It's a 5-year in prison punishment. So this is not something to mess around with. You want to make sure that you are not doing anything that could trigger anti-money laundering regulation. And the way to look at this from the crypto perspective is under the scope of one type of regulated institution called a money transmitter. And that's really what most crypto entities, to the extent that they are regulated under the AML laws, will fall under. And we'll talk a little bit more about the definition of a money transmitter in a second. But I think just big picture, you should think about it this way. If you are an entity that takes custody of customer funds, in other words, you have legal relationships with specific parties who give you their money to keep in custody for them, right? Either to keep safe or to send somewhere else for them, then you are a money transmitter. And what that means is you will have to register with FinCEN, you'll have to do KYC, and you'll have to do all of the other requirements, under the Bank Secrecy Act. It's not impossible to do that. And if you look at all the big crypto exchanges, the custodians, and many of the other what I would describe as centralized players like a Coinbase or a Kraken or a Gemini, et cetera, all of them are regulated under the anti-money laundering laws. And that's why when you set up a Coinbase account, you have to send them a picture of your passport, and every once in a while they'll challenge, whether you really are who you say you are and all that good stuff. However, if you are building a decentralized protocol on a public blockchain, you want anyone who has a wallet address to be able to transact with that protocol. You don't want to have to KYC everyone who's using it. You also might feel, as I do, and as I think Haseeb probably does as well, that the beauty of crypto is in building an accessible, open, permissionless, inclusive financial system that doesn't exclude people based on where they're from or whether they have a passport from a reputable government, or what they look like or what their history is. And so I think in general, the goal is to try to build a financial system that is more inclusive than one that the anti-money laundering laws would unfortunately require, since indeed the effect of the anti-money laundering laws in large part is to exclude people who are not able to provide those types of credentials that are required to get on the platform. So how do you, if you are an operator in crypto, make sure that you are not running afoul of the anti-money laundering laws? As I said, money transmitters are entities that accept funds from one person and transmit those funds to another person or location by any means. And FinCEN issued really exceptionally helpful guidance in May of 2019, which remains the sort of leading standard for understanding how the anti-money laundering laws apply in crypto. And I would encourage you to read them yourself if this is something that you're thinking about. They do a great job of explaining who in crypto is a money transmitter and also who isn't. So I'll give you one example to help sort of clarify the difference there. FinCEN talks about anonymizing service providers and anonymizing software providers. And there was a question about this a little bit earlier about, is it okay to have privacy over your transactions, or is it possible to sever the link between your identity and a wallet address in which you hold assets. And chiefly, the way that people have done that in the past is by using these anonymizing service or software providers, usually called mixers, where in the case of a service provider, there's a company. The company has a bunch of customers. The customers send their funds to the company. The company then commingles all of those assets into one wallet address so that it's unclear who owns which assets. And then the company will send those assets back out to brand new wallet addresses that are not linked to any of the initial customers, right? To any of the initial sources of funds. And what this does is it anonymizes the owners of those assets. When you get those assets back on the other side, there's no way for anyone to know that they belong to you as opposed to some other customer of that service provider. And what FinCEN has said is those anonymizing service providers are money transmitters. They take custody of funds, right? They accept funds from at least one person, and then they transfer those funds to at least one other person or to another location, meaning another wallet address. And they do indeed say different wallet addresses are different locations for the purpose of the money transmission laws. What this means is anonymizing service providers are regulated, and if they don't register with FinCEN and do KYC and file reports with the government, then they are in violation of the law. And I've given you a couple examples of this in these simple cases on this slide. This guy, Eric Powers, was running one of these services, a mixing service, back in 2013. He was doing it largely to help people get money onto the Silk Road, a darknet marketplace. And FinCEN said because he didn't register, he broke the law, and he had to enter into a settlement with FinCEN over that. Same story with this guy, Larry Dean Harmon, in 2021. He was running a mixing service related to another darknet market called Alpha Bay. And same thing, he not only had to settle with FinCEN, but he was prosecuted criminally by the Department of Justice. And so those are both anonymizing service providers. Compare this to anonymizing software providers. And you can think of those like developers who are building software that is non-custodial, right? Maybe it's the developers of a protocol like Tornado Cash or CoinJoin, or the provider of a wallet like the Wasabi wallet, or some other wallet that has some built-in mixing or privacy-preserving function. FinCEN says those developers are not providing a service, they're not taking custody of funds, they're providing software. And because they are not accepting funds, they're just providing software. They are not money transmitters, so they do not have to do anti-money laundering compliance. And this really is, I think, the guiding light for any of you who decide to launch a Web3 project. You need to think very carefully about your role in the project to make sure you cannot be categorized as accepting and transmitting funds from one person to another person or location. I've given you the simple cases of these guys, Eric Powers and Larry Dean Harmon. It's pretty obvious that what they were doing was money transmission. I also give you the example here of Arthur Hayes, the founder of BitMEX. BitMEX was not determined to be a money transmitter, although it certainly would have been because it was a custodial exchange. Instead, what FinCEN said was, BitMEX was a futures commission merchant, a regulated financial institution under the commodities laws. And by default, all futures commission merchants are also financial institutions under the Bank Secrecy Act. So that's the end of the story. If you're a futures commission merchant, you also have to do AML compliance. And Arthur Hayes and BitMEX did not do that. So Arthur also was prosecuted criminally as a result of that, individually liable for the conduct of the company that he ran. So again, extremely important that you make sure in the work that you are doing in your business that you are not running afoul of these laws. There are some more complex issues that no one really has good answers to. So for example, if you launch a DeFi protocol and you have an admin key that allows you to change the code that comprises the protocol, And you could change the code in a way that might have the effect of taking control of user funds or transferring user funds to some other address. Does that make you a money transmitter? There's no answer to that question. The same thing for multi-sigs, where maybe you don't have total control, but you have some control. The same thing with DAOs that have control over treasuries. All of these are difficult and unanswered questions worth thinking about. Let me pause there. Any questions about the anti-money laundering laws?
I think we're good.
Cool.
Oh, we just got one question that rolled in. So somebody asked, let's say we have a system like PayPal where users use crypto to pay for a transaction. Would such a system be categorized as a money transmitter?
So PayPal definitely would be a money transmitter because, again, they have customers, they take funds from those customers, they have custody over those assets, and they have custody over the crypto as well as the cash or other assets that they take custody of. If you're a merchant, so let's say you're taking payment from PayPal in crypto, and you're not taking custody of those funds on behalf of your customer, you're just getting paid by your customer for some good or service, then you are not a money transmitter. And in fact, the anti-money laundering laws clarify that explicitly. If you're a merchant taking payment for goods and services, you're not a money transmitter. Similarly, if you are moving funds for your own account, like let's say you're a proprietary trading firm, and in some sense, you are taking funds from some counterparties and then transferring those funds to other counterparties. Maybe you're a market maker, but you're doing that for your own account, then you are not a money transmitter. There's an exception in the law for that. There's also an exception for those who provide network communication services. So for example, PayPal is a money transmitter, but PayPal probably uses Amazon Web Services and any number of other network services. Those are not money transmitters, right? They're only providing the service to the entity that is the money transmitter. So you really have to dig deep into what is the specific conduct that you are carrying out, and does it subject you to regulation or not? And that's true across all of these frameworks.
Great. Let's move on.
Okay. The sanctions laws. Okay, I will speed through the next few so we can save some time here at the end. Really simply, the sanctions laws, a foreign policy tool that the US government uses to influence the behavior of foreign actors, people they don't like. Usually this is to punish foreign actors for doing things that the US government thinks is bad. So for example, Russia invades Ukraine, the United States sanctions Vladimir Putin and his regime. The government of Iran pursues development of a nuclear weapon. The US government sanctions Iran and all Iranian people as well. And again, the purpose here is to punish those foreign actors through economic penalties, right? The point is to say to Iran, if you want us to lift these sanctions, stop trying to develop a nuclear weapon. To say to Putin, if you want us to lift these sanctions, get out of Ukraine. And the way that this works, the economic penalty that is levied through sanctions is cutting the target of sanctions off from US markets. It is illegal for any US person to transact with or to facilitate transactions with or for any sanctioned party. What that means is it is illegal for all of us on this call right now to conduct any transaction with any Iranian national, even if they're just an ordinary Iranian citizen. And there are many reasons why, from a policy perspective, we might object to this. We can say that it is harmful, that it's inhumane, that it doesn't achieve its goals. But nonetheless, that's what the law is. It is unlawful for a US person to transact with any sanctioned party or to facilitate transactions for those parties. So what this means is if you are doing any work in crypto, any work at all, whether it is centralized or decentralized, it is up to you to make sure that you are not transacting with sanctioned parties or facilitating transactions for them. Again, I'll give you sort of the simple cases. If you are a centralized exchange or a custodian, someone like BitGo or Bittrex, you have to block all sanctioned parties from your platform, and neither of them did so adequately according to OFAC, the Office of Foreign Assets Control, which administers the sanctions laws. Both of them were required to pay penalties for failing to prohibit, I think, Iranian and also Venezuelan nationals from getting on their platforms. This is also true in a decentralized context. So let's say you have built a DeFi protocol and you also host a user interface, right, a web app or a front end that allows users to access the protocol. You cannot allow sanctioned parties to use that front end interface that you've built. And indeed, the industry standard at this point, even in that decentralized context, is for the operators of those front ends to geofence users from sanctioned jurisdictions. So you'll actually go in and say, users who have an IP address from Iran are blocked from this front end. And also, many industry participants have used blockchain forensics firms like Chainalysis or TRM Labs to even further try to identify and screen out sanctioned parties. So this is a really important issue because also sanctions laws like anti-money laundering laws carry potentially criminal penalties. And OFAC is very much paying attention to crypto right now as a potential threat for sanctions evasion. So sanctions compliance, definitely something to keep in mind. I'm just going to keep running through, seeing no questions showing up until we get through this section. The tax laws, look, everyone's got to pay their taxes. I'm guessing you'll all have heard of the IRS, the Internal Revenue Service, before. You have to pay taxes on crypto just like you do on anything else. If you make income in crypto, you have to pay income taxes. If you have capital gains from crypto investments, you have to pay capital gains taxes. All of that seems pretty obvious. But again, there's a huge amount under the tax laws that is not so obvious. So for example, if you obtain staking rewards, let's say you are running a validator on a proof of stake blockchain, do you pay taxes when you earn the staking reward? Or do you pay when you sell the staking reward? There's no good answer to that question. With airdrops, if you receive an airdrop, right, you get a claim on a token for free. Do you pay taxes when you can make the claim on the token, when you have actually claimed the token and you have control over it in your wallet, or when you sell it? Again, no answers to those questions. And the same thing for many other types of transactions. If you earn interest in a DeFi protocol, how and when do you pay taxes on that interest? And when DAOs conduct transactions, right? Let's say that a DAO votes to transfer funds from a treasury to a grants program. Well, is that transfer a taxable event? And if so, who pays those taxes? Is it the DAO? How does that even work? This is an unresolved question and one that has caused a lot of people to actually leave the US or to set up entities in non-US jurisdictions, either in the Caymans or in Guernsey, two very popular locations, to try to avoid the consequences of taxation for DAOs. And I'll skip over the infrastructure bill, but just to flag that the tax laws are changing and we're expecting guidance from the IRS, which will hopefully clarify some of these issues, but also potentially raise any number of new issues in the next few months. So definitely a fast evolving space. And on and on and on. So I won't go through all of the alphabet soup of regulators that you will have to deal with if you get far enough or deep enough into this space. I flagged just a couple of important ones here. The only one I want to say a few more words about before moving on are the consumer protection laws. The consumer protection laws apply in all 50 states and also at the federal level. And the basic demand of the consumer protection laws is not to engage in deceptive and unfair trade practices. A very, very broadly defined concept, which really boils down to tell the truth and don't hide things and don't misrepresent what you're working on. And this really becomes an issue, especially in the DeFi space, where often you will have a lack of disclosures about how DeFi protocols work, or you will have users who are using a front-end interface that has some information about, let's say, APYs or APRs, right? Promises about how much money they're going to make, but it turns out those promises either over-exaggerate the potential returns or understate the potential risks. And this has become a serious consumer protection issue. Even something like describing an asset as a stable coin, if it is not actually going to be stable, could be a violation of the consumer protection laws. So extremely important to make sure everything you say about your project is complete and accurate in order to comply with those laws. We've barely scratched the surface here, but my hope is this gives you at least a sense of the issue spotting that is necessary to navigate the regulatory issues in the space. Let me just do the current issues to watch, and then maybe we can take questions after that. And actually, I think I'll probably just speed straight through this. All I want you to take from this is, as I explained with the tax laws, crypto law and regulation is changing very fast, and you really do have to stay on top of it. I've talked a bit about how Congress may decide to pass new legislation regulating secondary markets, right? Maybe the CFTC is going to regulate all digital commodities. Stablecoin regulation, if you're working in the stablecoin space, this could change quickly. We've talked about concerns that anti-money laundering regulators have about privacy in the peer-to-peer context. This may lead them to propose new regulations that go beyond just financial intermediaries and regulated financial institutions. And so that's something very important to watch. DAOs, a lot of uncertainty about how DAOs will be regulated, how they'll be taxed, what types of liability they may be exposed to in light of the CFTC's enforcement action I mentioned. And then, of course, politics. So, we'll find out in the next couple of days who's going to control Congress for the next 2 years. And I think that could have a significant effect as well on how this all plays out. Let me stop there. And I think we have at least one question here.
Yeah. So question from Jerry asks, so many apps may reward tokens with may reward users with tokens and NFTs. Do users need to pay tax on these assets, or is this a unanswered question?
I definitely think they have to pay taxes. There may be some unanswered questions about when they have to pay and how much they have to pay. But if you get an asset for free, that's income, right? Or that's a capital gain, and you're definitely expected to pay taxes on that. And that's true whether it's a reward or from a company, or it's a staking reward earned through a decentralized protocol or an airdrop or anything else. If you're making money, you better believe the IRS wants its cut of that money. So yeah, pay your taxes.
Got it. All right, we'll save this last question till the end.
Cool. Okay. And am I right that we only have a few minutes left to see?
No, we end at 5:50, but we can also end early if we end up wrapping early.
Oh, perfect.
So you're good.
Okay, great. Okay, great. Well, I unintentionally, but happily saved a good amount of time to talk about the more useful stuff. Okay, so let's talk a bit more about Web3 legal strategy. Disclaimer, again, not your lawyer, not legal advice. If you're a Web3 entrepreneur, hire yourself a good lawyer, get some good legal advice. But hopefully this will help orient you to how you can go about that very difficult task, and also what the industry standards are, right? What the best leading companies are doing, despite the fact that there is regulatory risk and uncertainty in this space. And that's where I'll start in terms of your general approach to legal strategy. Number one, understand regulatory risk and uncertainty are unavoidable in Web3. You cannot do this work if you want to have zero regulatory risk. It's sad to say that, but the reality is leadership at current federal regulatory agencies simply do not agree with the prevailing industry views on how regulation should be interpreted and applied. And you have to come into this space understanding that. A lot of people have trouble with this because the traditional view, especially among lawyers, and especially among transactional and compliance lawyers, is there's a box to check. And if you can't check the box, meaning if you can't be absolutely 100% certain that you've done what you need to do to make sure you're not in trouble, then you cannot move forward at all. And that is just not how the crypto space works. There is some regulatory risk inherent in creating a digital asset, period. Just because the chair of the SEC thinks that every single digital asset in existence, except for Bitcoin and maybe also Ether, is a security. So you have to know coming in that that's the environment that you are opting into. And if you're not ready for that, then you should think hard about whether this is the right space for you. And I mean that seriously, not to scare you, but to level with you and to be honest about the position that we're in right now. I don't think that it will always be that way. In fact, I'm very confident that if you give us a good 5 or 10 years of aggressive policy advocacy and also development and adoption in the space, that we will get to a point where this isn't the conversation we have to have. But for today, it is the conversation we have to have. So how do you deal with that? On day one, the day that you start your company, maybe before then, right? You need to make and demonstrate a strong commitment to compliance. Things go wrong when people create companies and then don't care about compliance or think that it's just something that can be pushed off to some lawyer who can write some memo that will go in the file and then they never have to think about it again, or who think that compliance does not matter. Because ultimately, if and when you have a conversation with a regulator, which you will do at some point if you're in this space, right? And you should be preparing for that. When you have that conversation, you want to be able to show that even if you don't have exactly the same view of the law as the regulator has, you do have the same view of the underlying policy goals, whether that's protecting consumers or making sure that there aren't information asymmetries or whatever the underlying policy goal is, right? Making sure that bad actors don't abuse the technology that you've built. You want to be able to show that you are a good guy, right? You're a good actor. You're trying to do this right. And even if you have a disagreement as a matter of technicality or as a matter of law, regulators should not come after you because you are trying to do this the right way. And that starts with demonstrating, making and also demonstrating a strong commitment to compliance. Now, how do you actually do that, right? That's a very vague concept. And so here are some specifics about how do you from day one set up your compliance program. And that is how I think you should consider this. You should have a compliance program, even if you are 2 founders pre-seed with, $50,000 just to build, an MVP. You should still have some concept of what your compliance program is, even if your entire compliance program is an email from one founder to the other saying, hey, compliance is really important. We should look into these 3 areas to make sure that we are not doing transactions with sanctioned parties or with, people who are committing fraud or what have you, right? I think that's probably not even a bare minimum, but just be thinking about what is your compliance program? And the compliance program you develop can scale depending on the amount of risk that you're taking on. So if you're 2 founders with a WeWork and no product in the market, your compliance program can probably just be that email, right? Your risk is almost non-existent. If you are Coinbase with thousands of employees and millions of customers around the world, managing billions of dollars in assets, you're going to need to have a 100-person compliance department with a chief compliance officer who sits next to the chief legal officer, who sits next to the chief policy officer, all focused on this all day, every single day. And everything in between, depending on the amount of risk that you're taking on. So you tailor the size and scope of your compliance program to the risk that you're taking on. To do that, first and foremost, you have to have written policies for compliance. And this is, I think, my number one recommendation for the seed stage startup who is ready to put a product into the marketplace. You should hire lawyers and you should have them work up for you the basic written policies that everyone in the company needs to understand and needs to comply with. Probably what that includes is an anti-corruption policy, an anti-money laundering policy, and an anti-fraud policy. This is like super basic stuff that's just going to say, we are strongly committed to compliance. We do not want to do transactions with sanctioned parties. We are going to undertake the following due diligence measures for each and every one of our transactions to make sure we are not violating the sanctions laws. And it might just be you're going to collect the name and maybe a passport or some other identification from your counterparty, and you're going to run them through the Treasury Department's specially designated nationals list to make sure that they are not listed as a sanctioned party. And then you're going to keep a record of the fact that you did that check, right? Super annoying, extra compliance overhead, but extremely important, not only to make sure that you're complying with the law, but also to demonstrate your commitment to compliance, right? You cared about this before OFAC came asking questions. You cared about it because it matters, not just because you didn't want to get in trouble or you thought you might get in trouble, right? So demonstrate that, create a paper trail of that. And the same thing with, an anti-money laundering policy. We're going to do diligence. We're going to do a Google search to make sure this person we're not doing business with is a well-known terrorist or money launderer or something like that, right? These very basic steps that you can set up even in the early life cycle of a company to make sure that you are demonstrating your commitment to compliance. So do that. The other thing you should do is get legal counsel involved early in the product development stage. The worst thing that you can do, and there are so many stories of this, is you have a great idea, you build a product, right before you launch the product, you say, well, we should probably have legal review this. You then call the law firm comes in and says, this is totally illegal, do not launch this product. Because at that point, you've wasted a lot of engineering cycles, time and effort building something that is going to be really difficult to retrofit to be compliant with whatever the legal issue is, the regulatory issue is that the lawyers have raised. So get lawyers involved early and then check in with them often as you are developing your idea for what the product is. And the best lawyers will be able to give you actionable advice through the design process, not to say to you, don't do this, you're going to break the law, but instead to say, I understand the goal of what you're trying to build. Here's a better way that you can structure this piece of the product to mitigate the risk that you will have trouble with regulators down the road. So get lawyers involved early and then keep them involved in the process of developing your product so that you don't get surprised down the road that something that you've done is unworkable. The best way to do that, and if you're sort of mid-process or you've put together your idea of what the product is and now you want to have legal review it, is to ask a law firm to do a risk assessment. Risk assessment is a really common term of art in the legal world, and what it means, it really just like it sounds, is you'll have lawyers who understand all of these different regulatory frameworks, look at your product design and tell you, it's a low risk under the anti-money laundering laws, it's a moderate risk under the securities laws, it's a zero risk under the commodities laws, but it's a really high risk under the sanctions laws or what have you. And they'll lay out for you what those risks are, and then also make recommendations for you as to how you can mitigate them. Again, very burdensome process to have to carry out, but number one, it will help you understand and wrap your arms around the entire world of regulatory issues that you may come up against. And also secondly, it helps you demonstrate that commitment to compliance, right? No one was putting pressure on you. You were putting pressure on yourself because compliance matters. And not only did it matter enough for you to send an email, but it mattered enough for you to spend money on counsel in order to get this right. So really important thing for you to do. And then lastly, you should spend the time and the money to hire great lawyers. It's really hard to do. And I can give you some tips on sort of how to figure out, are you connected to the right lawyers or not? Because there are a lot of lawyers who either think they understand crypto and don't, or don't understand crypto and don't want to help you, who will give you answers that are not consistent with industry standards or with best practices. And so you don't want to get stuck with the wrong lawyer who's just going to say, I don't understand a blockchain. I think everything happening in crypto is scammy. I don't want to be involved in this. So just don't carry out whatever business plan you have. You should do this, by the way, both for outside counsel, which you should already have by the time you've set up a company, and also for in-house counsel. And I think one thing that we see often in the crypto markets is we see startups hiring in-house counsel much earlier than they would outside of crypto. I think Haseeb may have better views on this, but I think most tech startups outside crypto don't really think about hiring a general counsel or a chief legal officer until certainly after their Series A, maybe around Series B, and usually around like 50 employees or so. And in crypto, often it's before a Series A or at a Series A that you're hiring a general counsel, and more in the 10 to 20 employee range. And that's just a function of how important these legal issues are and how mission critical, how existential these risks can be to the success of the enterprise as a whole, that you want to get someone on board who's doing nothing but thinking about you and your issues at an earlier stage. So a really important thing to do. In terms of how to find those lawyers, honestly, I think being connected to a network like this, being able to ask me, and frankly, I'm happy to get these questions, or Haseeb, or whoever your investors are, who often know extremely well what the legal landscape looks like, or other founders who've already gone through this and have had good or bad experiences with lawyers. That's the best place to get advice. And then also, if you have a lawyer who you know and trust, to use them, use the benefit of their expertise, even if they're not in crypto, just to kick the tires, right? To have an early conversation or do an interview with a potential in-house hire candidate. I think that can be extremely helpful. There's nothing so great as a good lawyer, and there's nothing so awful as a bad lawyer. So I think it's really worth the time and the effort to get that right. The last thing I dropped
One
down
thing,
here.
one thing I would add, sorry, one thing I would add before you finish that point is so back in 2017 there weren't a lot of lawyers who really had crypto experience, and so you very, very often you had to settle with a lawyer who seemed competent and maybe was interested in crypto. Today there are many lawyers and many law firms or partners at law firms that specialize in crypto specifically. So today, if you want to get crypto legal advice, I strongly recommend you go to somebody who has experience working in the industry, as opposed to somebody who's just a general corporate lawyer who is going to opine very vaguely about what's going on in the industry.
It's such an important point. And to double up on that, if you do, let's say you do a seed round, you will have, venture financing lawyers who will help you with the seed round. Those are not the lawyers that you ask for regulatory advice. If you ask them, what they will do is they'll just loop in whoever the regulatory lawyers are at their firm, who may be great or may be completely terrible. And so usually it's great if you don't have to use 5 different law firms for 5 different things. But often in crypto, that is something that companies find themselves doing, using way more law firms just because that's what it takes to get the experts who really know the various different areas. So be prepared to do that. This is also why crypto startups hire general counsels so much earlier, because you, as the CEO or the CTO or the COO, right, or chief engineer, you shouldn't have to spend your days talking to lawyers, right? That's not the highest and best use of your time. And eventually you get to the point where, as CEO, you're just spending too much time dealing with all these law firms, and you hire the general counsel not to do all of the legal work themselves, but to manage the relationships with all the outside counsel who are doing the work and cut that down for you so that you can go focus on what's most important for your business or your project. So that's one way to think about it. The last thing I was going to say, and then let's open it up, is at the bottom of this slide, I put 2 resources worth looking at. The first is a guide that I worked on in my former life as a compliance lawyer in private practice at a law firm called Baker McKenzie, which is a good firm, although I have no idea how their crypto practices, so I'm not making a recommendation for them. But this guide is called The 5 Essential Elements of Corporate Compliance. And it's just an easy way to understand, how do the biggest companies, right, like the Fortune 100 companies, think about setting up an effective corporate compliance program. If you understand how they think about it, you will understand how the regulators are thinking about it. And if you understand that, then you can understand how you, even in a very different scope, should be thinking about it. So take a look at that. And the other is a podcast that I did earlier this year with Mark Boyeron, who was chief legal officer at a DeFi project called DYDX. He's now, I think, CLO or general counsel at Polygon. And he's also one of my fellow advisors at Variant Fund. And we spent like 90 minutes, probably way too long, talking about this question of when do you hire lawyers and why, and how do you find good ones, and what are the regulatory issues? So if you're not already wanting to cry from this conversation and you want more, that's a good place to find it. So with that, hopefully that was interesting, and I would love to take your guys' questions.
Cool. So first of all, a great presentation, Jake. So we got a question from Edgar, who asks, throughout your presentation, you've brought up privacy as an issue multiple times. Do you have any thoughts about how we reconcile the difference in ideals between Web3, which wants anonymity and decentralization, with the government's need to identify people in the long run? It sounds like they might be irreconcilable. Oh, Jake, you're muted.
Sorry. It's a great question. I think that this is one of the two existential questions for crypto, is how do we deal with illicit finance risk in a permissionless financial environment? The other existential question, just for fun, is will governments be okay with private actors creating money, which I think is also very fraught and an issue we'll probably have in the 2030s, not in the 2020s. But I'm hopeful that there is a needle that we can thread. I think, first of all, policymakers are open to this idea that we've gotten the balance wrong between law enforcement and accessibility, or put differently, we've gotten the balance wrong between national security and civil liberty, especially in an age where everyone across the board on both sides of the political spectrum in the US is worried about the rise of authoritarianism, right? The idea that we should have access to services, including financial services, that government cannot surveil and control, I think is picking up steam. So I'm somewhat hopeful there. That said, anti-money laundering regulators are hammers and they see nails, right? And all they can do with nails is hammer them. And for them, what that means is surveilling everything as a solution to the problem of illicit activity. I think it's on us in the industry, and I'll sort of lay this challenge out for any of you who care deeply about this issue, to figure out ways to use this technology to achieve, again, the underlying purposes of the anti-money laundering laws without having to resort to financial surveillance, right? To help law enforcement detect and prosecute illicit activity without also having to sacrifice everyone's privacy. And I think zero knowledge proofs are some of the most exciting developments in the space. And I think that there are ways that we might be able to have privacy preserving technology that nonetheless allows government to achieve its very important function of law enforcement. But we're not there yet. And I think the signs are not very positive from regulators in that they simply do not like the idea of a permissionless financial system. They would prefer the system where only 1 billion humans get access to finance and the other 6 billion are excluded if it means that they can stop a few bad actors from using the system, rather than our vision, which is much more inclusionary rather than exclusionary. But yeah, I think this is one of the big battles that we've got to fight out.
Got it. Okay, well, Jake, I think that's all the questions we have, and we're pretty close to time. So thank you so much for doing this. This is great. I think it was a very sweeping overview of everything happening in the space. And of course, crypto is one of these spaces that's constantly evolving, and the regulatory and legal questions are constantly evolving. And so next year, there were going to be undoubtedly different answers to those questions than there are now. Thank you so much for taking the time, especially on such a crazy day. And we'll be sending out these slides to everybody so that all the links that were in there, and if there's any particular points that you feel like you missed, you can go back to and Google some of the underlying questions. And of course, we'll also share with you Jake's email so that if you have questions for Jake specifically, you can reach out to him. So awesome. I think that's it.
Thanks so much. Yeah, this was a pleasure, and hopefully that was interesting and somewhat practical. And we'd love to hear from you guys going forward, and would love to come back and do this again next year. And we'll see what the state of crypto regulation is then.
Absolutely. Assuming we still have an industry left after this is all over, then we'd love to have you back on for the next one.
This is true. All right.
Great.
Cool. Well,
right.
I'm off, but have a good night. Thanks again.
Night, everybody.